Going to talk about employee shares, employee options, and how to use them to help you build your great teams. Obviously, a critical part of your journey as a founder. So yeah, I'm going to talk about a lot of stuff today. Some of it's going to be technical, accounting, tax, legal, financial stuff, but this is obviously a general webinar. I don't know your exact situation. If you really need specific advice, talk to us or talk to your accountant or your lawyer. But obviously, the information is as good quality as we can get. But yeah, there's the little disclaimer done. All right, so a bit about me. So yeah, I was a CFO for a family office for 5 years. I worked in London for 5 years, and so I did a lot of financial management stuff. And about 5 years ago, I came out into startups, and yeah, it was helping some companies to raise capital. And it was during that time that I sort of saw that this early stage space was very complicated, very technical. Deals are very slow, and it was really all over the place. And so now we've been doing Cake for about 2.5 years. So yeah, Cake's got over 300 active startups now in Australia. We're growing really fast. We do lots of ESOPs. So we've got a great understanding of the ESOP space in Australia. I'd say we're possibly doing more ESOPs than anybody else at the moment, which is cool. Yeah, we work with most of the best lawyers, startup lawyers in the country, and accountants as well. So we've obviously incorporated a lot of that learning into how we do things, and we work in partnership with them where we need specific advice. And it's our mission to make this simple and fast, which should be music to all your ears as founders, because you've got a hell of a lot to do, and nobody likes admin. So today we're going to talk about why do we want an ESOP, and because it is a bit of work. And then what's the recipe? How are we gonna bake that ESOP? So why do you want one? Well, helps you attract great people, saves you money, helps you retain key staff, increases productivity. You get to share your success with your team, and it saves you tax. So what do you want? I reckon they're just incredible, things for founders and for startups. Unfortunately, they've historically been incredibly difficult to implement. You've got to go, from the accountant to your lawyer and back again, and they contradict each other, and there's ASIC and the ATO, and it's just a huge amount of junk to deal with. And then you've got a ton of manual admin as well. So we're helping to resolve all that. So let's dig into these benefits. So this is a report from FinTech Australia. It's not only fintechs that have this issue, but attracting great people is a real challenge. Attracting engineering and sales and marketing talent is a real challenge. As startups, quite often we don't have the security that a bigger organization will be able to offer. We can't offer the big salaries that they are able to offer. So options are great for hiring. You can add significant dollar value on top of the salary package that you can pay in cash. You can add options on top, which is great for balancing out any cash shortfalls that they might be able to get, say, in a bigger enterprise. And great people, great thinkers, people that want to, build a better future, they quite often want a slice of the cake. You have to excuse my puns today. I think I was in a crazy mood when I wrote this. And the slice of that cake goes up over time, right? So if you're raising capital right now at 5 million for your seed, say, you're really trying to get that company to a $50 million valuation or more. So the team have the ability to work with you to 10x the value of that equity that they're getting. So there's some really significant upsides when you're hiring staff. Also, can it help with your runway? So we just talked about how it can balance out remuneration. So someone might be able to issue you $100,000 salary in one job, but a startup might only be able to pay 60 or 70 or 80. And you can use your options to balance that out, which is obviously gives you a big advantage when you're trying to hire great people. Quite often you can use options as a payment mechanism as well. So regularly we see options being paid to advisors and contractors for, you know, really discrete pieces of work. Options also work really well as bonuses. So it can be, you know, an annual bonus or quarterly bonus or for specific milestones. So, you know, really good for helping you extend out your runway, and any founders on the call will know, you know, how valuable that can be. So retention as well. I think no more relevant, this comment in a startup where, you know, so much of the value of your company is baked into your team. You know, they're the ones that are doing the experiments and, you know, building the product and doing the growth experiments and, you know, building those relationships. And when they leave, they can leave a really big hole in the company. So with regard to retention, I'm just going to shut this thing. I think there's a bit wind blowing in here. There we go. Just in case you could hear that. Yeah, so you can put a 3 to 4 year period on the options, which is obviously extremely helpful to sort of keep people sticking around, to see the value of their options rising as the value of their options are rising over that time frame. You know, they're much more likely to be really vested in the outcome of the company. Options can also be tied to specific goals. So, you know, if you've got a key team member and they're helping you to, you know, open up a new country or secure a major customer or a major partner or hit a particular sales goal or get the product released by a certain date or whatever, you can specifically tie those goals to their options, which makes it more likely that they're going to, you know, stay the distance and hit that target for you. Also very common to have a 12-month cliff. So if it's, say, a 3-year total period of the option scheme for that employee, in the first year, no options will go across to the employee or vest, as they say. And then at the end of that 12 months, they'll get, say, 1/3, and then it can be monthly after that. So all really nice mechanisms that are built in to your employee share option plan to, yeah, to help you retain your key people. So on productivity, you know, there's been studies in the UK and the US around productivity increases. It doesn't look like huge numbers, but, you know, compounding, you know, 6, 8, 10% per annum productivity increases, you know, really make a big difference as you go through the years. Teams that think like owners are more productive. You can align your ESOP to your business goals, as I mentioned on the previous slide. And startups really need these advantages because, you know, every little bit can count as you're growing your company. So hopefully you're sold on the benefits. Now we'll get into a little bit about how it works. So I see ESOPs. So ESOP is employee share option plan. I'll get into that in a little bit, but ESOP, as we call it here, it's really in 2 parts. Very often the technical part is where all the effort goes. And because it's so hard, by the time you've done the technical part, there's no time left for the people part. But in reality, it's the people part that's most important. Now, of course, you need to get the technical part right. But in our opinion, we need to automate, simplify, and streamline the technical part as much as we possibly can. Keep it in the background, make sure it's happening, so that you get more time to spend on the people part. You know, you're trying to build a great team. You're trying to keep them with you over the long term. You know, help them share in success of the company. There's some really great cultural aspects around that. You need to spend time on change management. You know, you can't just walk up to someone one day and say, "Oh, cool, here's an ESOP, like sign this letter, and then here's this 30-page legal document. Like, please understand that, you know, overnight." Like, it's not that easy. You need to spend time on change management. You know, you need to implement it properly, you know, make sure your team understands what's going on. And then you need to explain the value that's being created. You know, your equity is very valuable. Quite often I see founders undervaluing their equity, not talking about their equity like it has real value. If you don't value your equity, then who will? You know, your investors certainly won't, and then you won't get that round done, and your team won't, so they won't be really pushing hard to increase its value like you really, really need them to be doing. So the people part's really important. It's often largely forgotten. On the technical part, you've still got to get this right. This is where Cakes come in and streamlined a lot of things. So You've got to set up the plan rules. That's a bit like a shareholders agreement, but for your ESOP. You might need to get multiple valuations. I'm going to go into that in a bit of detail later. You need to get the members, so the current shareholders, to sign a resolution to actually implement the scheme. And quite often we see these all not done. Like, you know, we'll see customers regularly say, I have an ESOP, and then we'll scratch the surface and, you know, they'll have like perhaps a plan rules and no resolution signed and no offer letters sent or signed. And so it's like a partial ESOP that's really not implemented and therefore has no real legal or financial bearing. Now, of course, it can be fixed up later, but whenever you have these issues that need to get fixed up later, it creates delays, it costs money. I'm not talking about small delays. It could, you know, delay your next round by months and cost you 10, 15 grand to fix or more. You know, especially with tax, because quite often you can't unwind tax mistakes, which is why I highlighted tax there. You've got to keep your vesting and exercising up to date and keep your overall cap table structure, you know, in check. So options versus notes versus shares. So as I explain all that, like my mind just thinks of all the complexity and detail that goes into all of that. And if you've not done one of these before, you must just be thinking, what the hell is all this? And I wouldn't blame you. If you have done it before, I'm sure you realize all the junk that you got to deal with. So yeah, so this is just reiterating that you need to stay on top of it. We see so many of these things not being done well. And the worst thing is that your equity is going out the door. And so you're being diluted and your other investors are being diluted. But if it's not working, the employees aren't really even getting any value out of it because they don't really, you know, feel connected to it. It's not up to date. It's not professional. So, you know, it's a really terrible outcome. Fortunately, and this is just a quick plug for Cake, we have removed many of the manual steps. We have reduced a lot of the unnecessary communications already. We've simplified so many of the technical aspects within our software, and it's improving all the time. We're currently working on, you know, what we're calling one-click ESOP. So, you know, with standardized terms, you can really get through your ESOP very quickly. And we have in place excellent partnerships with startup law firms and startup accounting firms that can turn around any technical work that you need done really, really quickly, so that your ESOP can be set up and kept up to date, so you can spend more time on those people aspects of making sure your ESOP works really well. I think that's the only plug for today, so thanks for bearing with me on that. But we feel like we've done so much in this area, it would be remiss of me not to highlight that. All right, so what am I really talking about? So there are multiple types of ESOP, and there's also employee share schemes. Sometimes those words are used interchangeably, which is annoying. Employee share scheme is like an umbrella term, but it also sort of refers to schemes where you give the employees shares instead of options. Almost nobody does that. I think it's like 99-1 using ESOP to employee share scheme. So we really only talk about ESOPs. I don't even think we've done an ESS here, and we've asked around and no one's doing them. So since 2015, there's been a much more simple ESOP available to you. It's called the Startup Concession ESOP, and there's a much better tax situation for the employees mainly. So you don't want to, for example, give an employee $50,000 worth of equity and then them have to pay $20,000 worth of tax when they haven't had any cash go across to them to pay their tax bill. It's obviously like a super bad situation, especially considering, you know, they might not be able to sell those shares, and then the company might actually go under, you know, next year or the year after that, and they've already paid this tax bill. So it's a really, really bad situation. The new rules mean that the employee doesn't have to pay tax until they sell the shares down the track, at which time they normally have had an exit event, so they've got the cash to pay the tax bill. So the tax situation is really, really good. And there's also some significantly simplified sort of ASIC stuff as well, which I won't go into too much because it's a bit boring. Yeah, so to qualify for this startup concession ESOP, you can't be a listed company. You must be less than 10 years old. You can't turn over 50 million. Must be an active business. Yes, and not an investment vehicle. And you must be an Australian resident. So I'm pretty sure just about all startups will fit into that bucket. The only thing I'll say on that, the one area where we see people trip up is if they use an old entity. Quite often people will try and use some company they've had around for a few years and they'll change the name and then they'll use it. If you use one of those entities and it's older than 10 years old, you can't do this ESOP. And it's such a pain because the difference between this one and the traditional one is so significant. So really never use an old entity in a startup group structure. It costs you big when it comes to your ESOP. On the employee side, so they must hold the interest for 3 years to get the great tax breaks. Now, if the company happens to be bought out in the meantime, they still get the tax breaks up until the point of the buyout. But then once the exit occurs, obviously they need to pay their tax, but that's the same situation anyway as without. Each employee cannot hold more than 10%. So normally the founders can't participate, and I'm going to cover that in a minute. And they must be ordinary voting shares, so the same shares, I guess, as the founders, so that you can't really have a different class. All right, so getting into it a little bit more detail. So when you're getting started, so right in the beginning, we normally, say get your ESOP set up straight away. Sometimes people like to leave it until later, so like when they got their seed round done. But what we've seen and what we like to see is that, you can use your ESOP to get an advisory board. You can use it for your first hires. You can use it for sweat equity really early on. It used to be a bit difficult because it was really expensive to implement and maintain, but with Cake, that's not the case anymore. And as a matter of fact, with Cake, the first 5 investors is free. So you can start with Cake with 1 or 2 founders, set up your ESOP and actually issue your first few option letters for free using Cake, which is really cool for the guys starting out. Then when you get to the pre-seed and seed, there can be 2 rounds, they can be 1 round, they can be 3 rounds, depending on how things go. Quite often you might need a top up. So you might have used, 6, 7, 8% of your ESOP at that point. You might need to add another, 2, 3, 4, 5% to your option pool. You do that via a resolution. Again, using it for more advisors, using it for growing your team. So every new team member, likely gets some options. And perhaps some more sweat equity in this phase as well. This is normally an area where you're still in the valley of death, so you're just desperate for any type of funding and help you can find, and your ESOP can be really useful there. So once you get to Series A, quite often you need to top up a whole new ESOP. You might have exhausted your previous allocations, and you're getting a proper funded round in the venture capital or family office or sophisticated investor or strategic partner, whoever you get. They're likely to want you to have a full ESOP. They're likely to want that to be in place before you do the round because they don't want to invest their money and then get diluted. So you normally do another full ESOP then. You might need some bigger chunks to hire those, high-powered, really sort of successful people if you are hiring those sorts of people, at that point, if you need them. And again, for advisors and also for your growing team. So, you're potentially going to be adding quite a lot of team members through that sort of Series A, Series B phase, and you use your ESOP for those as well. Okay, so technical timeline. So this is on the nuts and boltsy stuff. So the first step is to choose your plan, rules, terms. So I mentioned before, you've got to set up like the shareholders agreement for your ESOP. So it'll handle all the technical stuff like good levers and bad levers and start date and finish date and amounts. And there's a heap of stuff in that. I think it's about a 20-page document. Fortunately for founders, there's only really a handful of things that you need to change, and the rest of it stays standard. And we really advocate that you don't muck around with those things too much. And we really also advocate that you don't really change too many things at all in a reasonably standard ESOP. Every change you make causes you pain. It causes you pain with your team, causes you legal fees, causes you problems down the track with your investors. And, as a founder, you need to keep it simple and fast. So choose some reasonably standard plan rules. Don't muck around with it too much. Our team can do it. Any good startup lawyer will tell you the same. Sign the members resolution. So that's the thing that actually says, look, the shareholders agreed to put this scheme in place. That obviously needs to match with your constitution or your shareholders agreement. So that's all aligned. Then you need to get a valuation. There's a specific valuation that you need to do to qualify for the startup tax concession, ESOP. I'm going to go through that in a minute. The next step is sending the offer letters out to your team. So this is, remember, this is just the technical stuff. I'm going to go through the people stuff in a minute. So send them a letter, and it needs to say, you know, this is your name, this is how many options, and it has the start date and the finish date and the option price and the exercise price and all that stuff in it. It's a pretty technical letter, which is why it goes out with some sort of covering fluff. No, I shouldn't say that. Some copy and some change management information and some FAQs to help your employees through that, because it's like when you first get it, if you've never seen one, I'm sure you'd be pretty shocked. We've been through a lot of that. And then, yeah, so then once the offer letter's been signed, then the next step is the employees start hitting the goals that you set for them in their offer letter. So in that offer letter, it'll say, look, if you stay for 3 years, you get options over the 3 years, or if there's a cliff, or it might say there's some specific options that are related to a particular milestone that the company is trying to hit. Now, as those goals are being hit, then that's another stage in the process where it's called vesting, and the options then go essentially from being controlled by the company to being controlled by the employee, which then leads us on to the next step. So there is what's called exercising. So once the options have vested, the employee has the right to exercise those options, which means that they convert from an option to a share. And so that's when they go from, I guess, actually on to being on your actual share registry, and you would go and update ASIC and say, look, shares have been issued. And there's also some ATO reporting that needs to be done annually as well. So there's quite a bit to that. Many of those steps are highly streamlined and automated and connected together in the Cake platform. So you can check that out yourself or with your advisor when it's the right time.
Hey, Jace, just had a quick question from Libby. It's the same process if it's like a board of advisors or something like that as an employee. Are there any real differences around that? It's a great question because you can use them for advisors, not only employees.
Yeah, there's really absolutely no difference in the technical aspect. The milestones and the goals that you might set for an advisor would be different, or a contractor. So a contractor might do a discrete piece of work. So, I know a marketing consultant that will work for options if he believes in your company. So he might say, look, I'll do 10K worth of work. You give me 10K worth of options. At the end of that piece of work, he'll get options instead of getting paid. So that vests just over like a discrete piece of work. Now I think I'm going to mention this later. It can't be an agency. You can't go out to like an agency with 30 marketing agents and sign them up for your ESOP. It really has to be an individual contractor. Now the second type might be an advisor. Actually, I'm going to go through this later, but with the technical aspect, it's all the same. And then I'll go through some use cases later. All right, so the people side of things. So this is all about making sure that you're building a team that's connected around, your company's vision, and enabling them to come on this journey with you. And largely, as much as you can, hiding all the technical aspects and keeping not hiding them to like trick anyone, just hiding as much of the complexity as you can and explaining the complexity as simply as you can, so that they feel connected to it, they want to participate. And then you can get into the more powerful things around, actually really using this as a tool to help grow your company. So the first thing is, you need to have a company strategy around your ESOP. How big is it going to be, and how are you going to talk about it? And do you believe in it? Like, do you believe in having employee ownership in your company? And are you going to build it into your culture? And if you are, then it's great. If you don't believe in it, then change your mind, or don't do it. Or it's just not going to be valuable for you. So then you need to sort of set the scene. You need to have some emails and some meetings, or however you want to do it, to talk about what it is and how it is and how it works, and how it's going to form part of your company's day to day or month to month and year to year practices. So provide a bit of leadership around it. You're going to need to do some FAQs and some follow-ups, because there'll undoubtedly be a few things that people don't understand. We've got some FAQs that we always provide with our ESOPs to help the employees to sort of make sure that they're comfortable with it. As I mentioned before, if they're not going to value it, and your equity is going out the door, and the employee doesn't even value it. So obviously that's not the outcome we want. You really need to keep the vesting up to date. So if you've sent someone an offer letter, or the worst still, what we often see is we set up an ESOP, you have a meeting, you tell someone they're getting some options, and then you never talk about it again. So they kind of half think that they have some, but they probably think, well, I don't even really know if I would get anything if we had an exit. I don't really have a document and I don't feel connected to it. Obviously, that's not what we want when we're implementing these things. So you need to keep the vesting up to date. If it's monthly, if it's quarterly, if there's a cliff, you need to communicate around those milestones to make sure that your employee feels connected to it and that they understand what's going on. And then connect it to your performance updates. So, however you run your performance management in your company, it can be rolling, it can be quarterly, annually, whatever, it can be milestone based. Make sure you're talking about the options in relation to that. So, it's part of your team culture and I guess your overall remuneration strategy. And finally, you need to maintain a growth narrative in the same way you do with your investors. So if someone has $50,000 worth of options and you run a new round and you double the value of your company, you really want to tell them that that 50,000 is now worth possibly $100,000. They might have been diluted a little bit, so you need to take the dilution into account. We've got a tool for this as well that I can share with you if people are keen, just a little sort of forward-looking value creation model with some dilution in it. You make sure you talk about that. If you've done a round, tell your team, well, the investors that came into that round, they've invested because they think we can 10 or 20x this company. What happens if we do 10 or 20x that company? Show them what their options, will be worth in that situation. It's not always that easy for them to be aware, and it's really a valuable driver financially and culturally. Cool. So some use cases. So these are the sorts of things that we see.
Hey, just a couple of questions. One was just around the exercise price on an option. So it's more of a technical question, but do you want to just maybe even talk a little bit about how most startups actually value their company, and then using the NTA, and then the question was also in relation to when they exercise their options, do they actually have to pay the price for the option? So
awesome. Yep, I've got a page on valuation coming up soon, so thanks for that question. Obviously very important. I'll be on that very shortly. All right, so in the meantime, use cases. So look, this is just, I've been as honest and open as I can. There's obviously lots of different ways to do this, but I thought, look, I'm doing this a lot. We're doing this a lot. We have a lot of learnings, so I'll just put it out there. And this isn't one size fits all. And if anybody has better opinions or thoughts, please share, because I'm super keen to learn. But founders, so you normally can't be in your ESOP if you're a founder. Almost all founders have over 10%. But you can set up a separate ESOP for the founders. There's specific rules about how you need to do that. Essentially, I won't go into it in too much detail, but you can do that, and it can be important to do that because you kind of want the founders to be incentivized, and sometimes they can't be getting paid a lot. So you can use an ESOP for that, but it can't be the startup concession ESOP. So talk to us or your lawyer or accountant about that. Advisors and board, it's a great way to get some powerful people in to help you. There's lots of great people out there that want to help you, but it's nice to be able to remunerate them. It can be simpler just to do like 0.5% to 1.5% over a 3-year period, and so that happens monthly, and then you keep up to date with them and make sure that they're adding value on a monthly basis. And if for any reason you guys drift apart, you can always just stop that and lapse that back into your pool. But ideally, they stick with you over that time frame, and they're able to generate some significant value, because as the company goes through a couple of rounds during that time, that 0.5% to 1.5%, which in the beginning was just a very small amount and have a very small value, over that time frame can really go to be worth something quite meaningful for them. With those guys as well, it can be more discrete, so there can be a certain amount per month calculated as a dollar value against the prior round value and stuff like that as well. First 5 employees, look, it's a trickier area. Quite often you don't have like a real valuation of the company at that point. I'm going to go on to valuation in a minute. So sometimes it's easier just to have, 1% each over 3 to 4 years. So again, if the company does well over that 3 to 4 year period, it can be incredibly significant financial outcome for those people. And, certainly a very powerful and meaningful driver for the founders. I know it's a big part of, what drives us at Cake is to help our first team members, have a big financial event if and when we make it through our rounds. So scaling your team. So once you've sort of got that first, 5, 6, 8, 10 employees, then, you might really be scaling and hiring fast. So, normally then it goes into a more traditional sort of pay and bonus structure. So as I said before, you can use it as top up pays to a market rate, and you can also use them for bonuses really effectively as well. And it's just quite often a simple financial calculation, company value, the pay value, bonus value divided by the company value tells you how many options it is. So it's reasonably straightforward to work those out.
Hey, Jace, I just got a question which was actually probably relevant for this point. Do you have to offer it to all of the members in your team or all of the contractors you've got if you're offering it to just a few?
No, you definitely don't. It's entirely up to you. I guess from a transparency and fairness perspective, you need to keep it as transparent and fair as possible from a cultural perspective, but there's no legal obligation to offer it to everyone. Yep. Then contractors, yep, you can do contractors. As I said before, in sweat equity, it's great. I mean, early on, particularly when I was starting out in startups, I'd see a lot of these sweat equity agreements where you get this and that and this and that, and I'd never really see any documentation around that. And it certainly put me off, working in that situation. And so I highly recommend be as professional as you can with your equity. Make sure that you get your ESOP in place, you get the offer letters in place, and that people understand that, you're operating your equity professionally. And if the company does really well, then they're going to be able to participate. I think we all know advisors that have worked for sweat equity before that have got really no idea where all that is, and that's not good for you or the advisor or the ecosystem. So we need to really tighten that up. So valuations, been a few questions on this. As a former CFO, I'm sort of pretty good with all this stuff, so I'm going to try and work through this as best I can. It's not a simple thing to do, but it's definitely doable. So there's two types of valuation when you're doing an ESOP. So the first one is, the market valuation or the valuation that you would raise capital at. So let's say, for argument's sake, I'm a seed stage company. I'm raising at a $5 million valuation. That's obviously, is it a pre-money or post-money? Share options price. So that'd be the pre-money valuation. So the price of the share is $1 in this. So just say, and there's multiple ways to calculate that. I think if you're just starting out, I would normally recommend the Burkus method. Get a $1 to $2.5 million valuation can be really handy just to help you understand what your company is valued at. So for example, I had someone ask me the other day, I had a software engineer who was going to do $100,000 worth of work for me. Like, how do I know how many options to give them? And so, just sharing out loud, I said, well, do the Burkus method. Just say for argument's sake, it says your company's worth $2 million. They're going to do $100,000 work for a $2 million company. So that's roughly 5%. Nice way to get like a good, simple financial situation going, in that discussion. You can also, do some multiples as well, because quite often they're foregoing, cash into the company. So there can be some, multiples, so 1.5, 2 times multiple on the 100K, and they might end up with, say, up to 10%. But again, it depends on the circumstance and the negotiation. But using the Burkus method to value that is really helpful. So let's go back to more of a seed stage company, say, or perhaps a smaller Series A stage company with a $5 million valuation. So that's your raised valuation. Now that's very different to the startup concession valuation. So this is required for the startup concession tax break. If you don't do this valuation and you don't follow the rules, the whole startup concession ESOP is essentially defunct. So The simple explanation of it is you take the net assets of the company. So you go to your Xero account with your accountant and you make sure it's up to date and you get that net asset figure from your balance sheet and you divide it by the total number of shares and options. That gives you the minimum exercise price for your option pool. Now we use startup accountants. They do that for us on a fixed fee for $600. Most of our founders use that process just so they have that on hand, but you can go to the ATO website. They explain exactly how to calculate it. You can do that yourself. So that's entirely up to you. But those are the two types of val. So the valuation for your exercise price might be 10 cents, but the valuation of your share price might be $1 based on your raise or market val. So I hope that was clear. If there's any questions on that, please shoot them through. I'm going to go through an example now. So how do I work out how many options to grant a team member? So this is how my mind logically worked it out. I hope it works for you. So if the market valuation of the company is $5 million and the net tangible assets on your balance sheet is $100,000 and you want to give the team member $50,000 worth of options over 3 years and you've got 1 million total shares and options on issue. So those are the numbers that you need to do this. You need to know the market valuation of the company. You need to know the net tangible assets of the company. You need to know what the dollar figure is that you want to give the employee. And you need to know how many shares and options are on issue in total. So if you know those 4 things, you can work all this out. So the first thing is to work out the price per share. So $5 million is the val. It's 1 million shares and options, so it's $1 per share. Everybody can work that out. The team member's getting $50,000 worth of options, and it's $1 per share, so they get 50,000 options. I think everyone can work that out. Mind you, I shouldn't say that because some people, like, this is really difficult for a lot of people, so don't feel bad if it's difficult for you. This is just a really tricky sort of process, and I'm like a 20, I don't know how old I am now, I'm like a 20-year finance guy, so I do apologize if I'm oversimplifying this, but I think it's, yeah, I hope, if you're not sure, please ask us, we can help you with this. And then the exercise price is 10 cents because the net tangible assets is 100,000 and we've divided by the 1 million shares and options. So now we know the share price, how many options they're going to get, and the exercise price. So then flowing on from that, they're getting $50,000 worth of value. And when they exercise, they only pay $5,000 because it's 50,000 options divided by 10 cents. So they pay $5,000. So the difference, the $45,000, is created by the scheme. It's a really powerful lever for the founder to use, especially early on, because you've sort of created $45,000 out of nothing. And you can see how powerful that is if you're trying to incentivize someone. You might have, just say you've done a $200,000 round, but you might have another, $500,000 in option value that you can use to incentivize your team. It's an incredibly powerful financial driver. I could go into that in a little bit more detail, but it is a really powerful financial driver. And then the real market value when they exit could be 10 times that. So you've given them $50,000 worth of options. It's only cost them $5,000. And ideally, you're going to try and make it worth $500,000. So again, really powerful financial drivers that good founders that can tell a good story around their ESOP can use to build their company. Which I guess leads me to one of my final slides, culture eats strategy for breakfast. I think ESOPs and team ownership and sharing in the success of your company are really important drivers for you and for your company. It'll help you to attract and retain and engage great people. And sharing in the success of your company with the people that have helped you build it, it should be and is, a really powerful driver for great founders all over the country. Just going to skip over that. So look, so Cake works well with just about anyone in the ecosystem. If you've got an accountant or a lawyer that you're using that's a startup one, you can still chat to us and work with Cake. If you're working with a VC, we work well with them. If you're in a co-working space or a hub, we work well with them. There's quite a lot of good discounts out there, for getting onto Cake as well across that. You know, with Cake, you will have simplified and streamlined process and a lot more peace of mind. You know, if you mention this webinar to any of my team, if you hit us up, there's 20% off for 12 months. And yeah, at that point, I might just throw us open to some questions.
Jace, I've got a couple of questions that we haven't gone through on the chat. One was, what happens once your company is older than 10 years old? So do you want to just explain what that threshold means in terms of being able to issue new ones and for existing ones that are outstanding?
Yeah, look, there's so the key deadline for the 10 years is that the scheme has to be set up and the offer letters have to be sent. Once the offer letters are sent and signed, they can still vest and be exercised after the 10 years. So that's just where that 10-year threshold kicks in. If you have fully passed the 10-year threshold, you can still implement an employee share scheme. You know, there's a tax deferred scheme. There's a couple of other schemes that you can use. They're still, you know, great tools. The good thing is the later stage schemes, so the schemes that work after 10 years, they're more tailored towards companies that are profitable and paying dividends, and, you know, so there's more likely, so they just work a lot better in that circumstance. So there's definitely schemes you can use, and, you know, once you're older, and, you know, we work with those and our partners can definitely help set those up. So that's all good. I think Darren's corrected one of my calculations. Yeah, I was doing that a bit quickly earlier, but I think, yeah, you're right. Nice. Thanks, Darren. Whoops. I'm a CEO now, not a CFO, so.
We had another question which provided a response on, but it might be worthwhile sharing more broadly. Like, what happens if there's a dispute with an employee, or let's say they leave on bad terms or whatever? What do you do in those circumstances?
Yeah, so that's one of the most common terms in the plan rules that we talk through with founders when they're setting them up. So there's two main categories that levers fit within: good levers and bad levers. So the first thing is you sort of specify in the plan rules what a good lever is and what a bad lever is. So a good lever would normally, you know, normal circumstances, you know, they leave, they resign, or they need to go to another role, or, you know, they have some family circumstances that mean that they have to leave, and you can sort of set those. And we normally have sort of company friendly and in between and employee friendly versions for founders to choose between. And then when they leave, the company has the right to buy back their shares at a predetermined price. So it could be at market value, it could be at a discount to market value, as long as it's sort of fair between the company and the employee. Now, when people leave under bad terms, that's called a bad lever. You again set that in the plan rules. So that would be, you know, normally if obviously they were fired, if they did something fraudulent, you know, and you sort of specify in those sorts of things, and you can then take back or buy back the shares for as little as $1, you know, 20%, 50%. So it's normally a much more punitive situation where the company will be taking back those shares or options, you know, for very little to no compensation, I guess, just depending on the circumstance. And the company has the right to set that up how they like in the beginning. So that's obviously something that we normally help founders with through our partners as well.
So I just had a follow-up question to that, Jace, just around, you know, are the plan rules, are they relatively standardized or whatever? I know you did talk to this a little bit earlier, but it might be worthwhile just reiterating that and kind of what's in the Cake templates that they can access through the platform, etc.
Yep. So as I said before, there's 5 or 6 clauses within the plan rules that we would recommend a founder looking at. Good levers and bad levers is one, the total term is another, the exercise price is another. So there's a handful there. They're not very complicated to work through. Within the Cake system, we've got like a standard set that we consider to protect the company but be employee fair, is how we describe them. And so each of those has been set with a predetermined sort of standard answer for each. Now that you can use within the cake system just with the click of a few buttons. Most often, and we do recommend this to all the founders, is to just get a little bit of legal advice. Make sure you understand all the terms. So come to Cake, we'll then refer you to one of our preferred lawyers who, they're simple and fast. They know how to use the Cake system. They'll help you through those clauses. They'll make sure you understand it. They'll make sure you get the resolution signed. They would compare it against a shareholders agreement or your constitution just to make sure it's well aligned. Get it signed, get it in place, help you understand the technicals of the offer letter. That's a really valuable process to go through with one of our legal partners. If you've already got a lawyer, bring them in. If they haven't seen Cake before, it's very easy for them to understand how to use our system. So you can definitely be your own lawyer as well.
I had a kind of similar question, which is around ETOP valuations. Do you just go to your normal accountant? I think it would probably, the answer that we would give is, if your accountant knows how startup ETOP concessions work and everything, then fantastic. A lot of the suburban accountants won't necessarily know that. We actually have a panel of accountants that actually just do this day in, day out. So they know what the rules are, how they should be applied to startups. And so we can connect you with them really easily. So, yeah.
Yeah, for sure. Like one of the traps, if your accountant isn't doing, 10 of these a year or 5 or 10 of these a year or more, they're not unfortunately going to be able to, give you the outcome that you're going to want in the time frame that you're going to want. Startups is a whole beast on its own. We've learned that so many times through working with our customers. So if you don't have a startup accountant or a startup lawyer, I would recommend looking into doing that because the difference can be significant.
A couple other questions. We had a question about do non-tech-based companies use ESOPs? Yeah, absolutely. Like if you're a startup, it doesn't matter really. Like the principles are all the same. So you don't have to be a tech business to use the ESOP. So that's 100% correct. A question from Barbara just about if you're offering over 10% of your shares in the option pool, what does that mean from tax, and then also in terms of Cake's platform? Jace, do you want to?
Yeah. What happens with the excess percent in regards to tax? Yeah. So at a high level, if you need to grant options to someone that has more than 10% of the company, or you need to issue them more than 10% of the company, there's multiple ways you can do it. If you're very early on, as in like pre-revenue, PMBP, and you could arguably ask your accountant, do I have an overall company value of 0, tax value of 0, then you could perhaps just issue them the shares, and then you can put it into the shareholders agreement. Any vesting, you write it into the shareholders agreement. All founders should have vesting attached to their shares for a range of different reasons, just to protect the company and help in bad outcomes, which do happen all the time, actually. So that's one way to do it. If you've already kicked off and the company's running and there is a valuation of the company's shares, so just say you've done a round, you really can't get away with that, because if you give someone, say, 10% of a $5 million company, you give them $500,000 worth of value, arguably they're going to have a $200-ish thousand tax bill, which obviously nobody wants. So in that circumstance, there's a way to issue options under a separate scheme with some specific calculations around the exercise price. So the exercise price can't be at a discount to the market price. Actually, it has to be higher than the market price. And there has to be an amount that's paid for the options at the start as well, which we haven't covered because it's not relevant for the startup concession. But that's a reasonably tricky area of law and tax, but can be done. You just need to go through a slightly more complicated process to do that, which we can do and our partners can do, but just be aware it is a bit of a bigger process.
I think
I'm natural footed, by the way, just in case. I can fall off natural or goofy footed, but I fall off a lot less naturally.
I think Jace probably does his best work on the golf course though too. So
Good golf.
if you've got an Ambrose group going, he's a good one to throw in there, a good roughie.
Especially if there's some big water to carry.
Can you have unlimited, or just a couple other questions? Do most employees set up a trust, or what entity do they actually hold? Use that, Jace. Like, do you have any kind of views on that? I know it'll be up to individual circumstances a little bit, but I don't know whether you've got any kind of
Yeah, as a general rule, I think it's some do and some don't. I think, and it also sort of perhaps depends on the sophistication of the employee. So, just anecdotally and without giving any advice, I think, to set up a trust for a small amount of options might be overkill. But at the same time, if they go on to be worth quite a lot of money over the years as well, having the, benefits of a trust, can be there. I mean, I think honestly, from what I've seen, it's probably 70 or 80% don't have a trust, and maybe 20% do. But again, it's more of a question for the individual. I think I personally would have a trust in all circumstances when I'm dealing with investments, but I'm an accountant, so it's not too hard. Yeah.
And I had a question, which is kind of an interesting one about, can you have unlimited participants in an ESOP? It's probably less an issue for the ESOP, but more for like some of the other startup concessions, Jace. I don't know whether you want to just touch on that one briefly.
Oh yeah,
good point. 50 shareholder.
Good point. So in the ESOP, theoretically, there's no limit, but there are some other limits around your equity that need to be taken into account. One thing we didn't cover yet, I guess, is the ASIC disclosure requirements. And there are some rules around the dollar value of options that you're able to issue to your team in any given year. So we probably should, I don't think that covers this question, but I think the other part of this around, I guess, the Section 708 exemption. So in each 12-month period, you're only able to issue equity to 20 retail investors. So people that don't satisfy sophisticated or wholesale or professional investor, and your option holders will fit into that category. So if you've done a round and you've taken on 10 retail investors, and then you start issuing your ESOP, make sure you calculate the total number of retail investors that are receiving equity or options in a 12-month period. You also need to think about the total number of shareholders in your cap table. So the limit for a private company is 50. And while your option holders don't count within that 50, when they exercise, they will. So you just need to sort of keep track of, one, that 20 investor limit, and two, the 50 investor total limit, which is probably more relevant for seed and Series A companies.